The shimmering mirage of California's gold rush faded centuries ago, yet a new kind of fortune hunting persists in its sun-drenched valleys. Here, in the sprawling expanse known as Silicon Valley, wealth is minted not from ore, but from audacious ideas, from lines of code, from the very fabric of our digital future. It is a realm where billion-dollar valuations appear overnight, where the impossible is merely a funding round away. But behind the myth of the garage startup and the visionary founder lies a more intricate, often unseen, engine of creation and control. The untold story of Silicon Valley money, a narrative as complex and transformative as the technologies it fuels. And the seeds of this financial revolution were sown in the aftermath of the Second World War. The Cold War accelerated military and governmental investment into scientific research and development, particularly in electronics. Stanford University, nestled amidst fruit orchards, became a crucial nexus. Professor Frederick Terman, often called the father of Silicon Valley, actively encouraged his students and faculty to launch companies in the immediate vicinity, fostering a symbiotic relationship between academia and industry. This was the nascent stage, a time when engineers were tinkering with vacuum tubes and early transistors, often funded by defense contracts, unknowingly laying the groundwork for a future economic superpower. And the true inflection point arrived with the invention of the transistor at Bell Labs in 1947, a discovery that would fundamentally reshape electronics. William Shockley, one of its co-inventors, moved to Mountain View, California, in 1956 to establish Shockley Semiconductor Laboratory. His brilliant but abrasive management style quickly alienated key employees, leading 8 of his most talented engineers to leave in 1957. These rebels, dubbed the Traitorous Eight, sought backing for their own venture, Fairchild Semiconductor. Their financial salvation came from an unexpected source: Sherman Fairchild, a wealthy East Coast industrialist and investor who provided $1.5 million in exchange for an option to buy the company within 18 months. This was not traditional bank debt, nor was it a public offering. This was an early, pivotal instance of what would become known as venture capital, a high-stakes, high-reward gamble on human ingenuity. And Fairchild Semiconductor quickly became a vibrant incubator, spinning out dozens of companies and countless millionaires. Its alumni would go on to found Intel, AMD, National Semiconductor, and Kleiner Perkins, among others. The Traitorous Eight's success demonstrated a powerful new paradigm, that investing substantial early-stage capital into unproven technology companies, even with significant risk, could yield unprecedented returns. This era birthed the modern venture capitalist, individuals like Arthur Rock, who invested in Intel, and later Don Valentine, who founded Sequoia Capital, an institution synonymous with Silicon Valley's success. These pioneers understood that the most revolutionary ideas were too risky for conventional banks, but held the potential for exponential growth that dwarfed traditional investments. And the economic model that solidified in Silicon Valley was distinctly different from established industrial finance. Rather than lending money against tangible assets, venture capitalists invested equity in companies based on intellectual property, market potential, and the strength of their founding teams. They took significant ownership stakes, actively mentored management, and guided strategy, aiming for a grand exit, typically through an initial public offering or an acquisition. This was not merely passive investment. It was active partnership, a high-touch, hands-on approach designed to de-risk volatile startups and accelerate their path to market dominance. The venture fund itself was structured to pool capital from limited partners, pension funds, university endowments, wealthy families, and sovereign wealth funds, who, in exchange for a share of the profits, entrusted their money to general partners, the VCs, who managed the investments. This model, with its management fees and carried interest, created powerful incentives for VCs to seek out and nurture the next technological giants. And the dot-com boom of the late 1990s and its subsequent bust in the early 2000s served as a fiery crucible for the venture capital ecosystem. Billions of dollars poured into internet startups, many with little more than a business plan and a catchy domain name. The bubble burst, wiping out immense paper wealth and leaving a trail of bankruptcies. Yet the lessons learned were invaluable. VCs became more disciplined, focusing on sustainable business models, clear paths to profitability, and the long-term potential of network effects and platform dominance. This shift paved the way for the rise of companies like Google, Facebook, Apple, and Amazon, which emerged from the ashes stronger and more strategically sound, proving the resilience and adaptability of the Valley's financial engine. And today, Silicon Valley money orchestrates a global symphony of innovation. Venture capital is no longer confined to Sand Hill Road. It has expanded globally, replicating its model in Beijing, Berlin, and Bangalore. The scale of investment has grown exponentially, with megarounds exceeding hundreds of millions, even billions, from institutional investors and sovereign wealth funds seeking to tap into the unparalleled growth of the technology sector. Companies are staying private longer, raising colossal sums from private markets, delaying their IPOs for years, meaning much of the early wealth creation is concentrated among founders, employees, and the venture capitalists themselves, before public investors even get a chance. This trend has significant implications for wealth distribution and the democratization of investment. The invisible currents of capital that flow through Silicon Valley continue to shape our world, often in profound and unforeseen ways. This financial architecture, built on risk, reward, and a relentless pursuit of the next big thing, has given us technologies that have transformed communication, commerce, and culture. Yet it also concentrates immense power in the hands of a relatively small number of individuals and institutions who decide which ideas get funded, which futures are built, and ultimately, who benefits most from the digital revolution. The untold story of Silicon Valley money is a reminder that while innovation is celebrated, the mechanisms that fund it, the economics that sustain it, and the power structures that emerge from it are equally vital to comprehend. For in understanding these unseen currents, we begin to grasp the true architects of our modern age and the profound implications of their choices on the world yet to come.